Hey, this is Jenny Jones, retirement coaching expert and podcast founder of Retirement Chat Radio. Hey, what I wanted to do was there's a lot of people contacting me. I even clients, I still manage portfolios as well as coach people in retirement. They were saying, man, what happened to Silicon Valley Bank? What happened to, these banks collapsing and falling? I'm going to share with you in the next couple of minutes what actually happened and how you can probably avoid it in the future. It's not going to take me that long. I'm going to try to be as less technical as I can, but I kind of want to separate all the noise that's going on and just break it down to something very simple for you to understand. Let's go over to my computer. All right, so let's start with the basics. Let's start with the beginning and how it all kind of started. So after we had the banking collapse, right, of the Great Recession back in 07, 08, when we had the whole collapse, you had Washington Mutual, you had Countrywide. Remember that big fiasco? Well, as a result of that, they created what's called, this was under the Obama administration, this is one of the first big sweeping things that he did, was they had what's called the Dodd-Frank Wall Street Reform and Consumer Protection Act, right? And what that act was supposed to do was it was supposed to make all these sweeping changes, right? And overhaul the whole financial regulatory system. And what they did was they created a list. Remember how everyone kept saying too big to fail, too big to fail? This is pretty much the list that they've determined to be too big to fail. I think it's 30 or 32. I can't remember, but it's about 32 banks. So they said all of these banks are connected in some way, somehow. And so this is a whole nother tier of banks, right? And so, but let's talk about what happened and how let's fast forward now. We're in 2023. Let's talk about what happened. We'll start on probably February 24th. But before we get there, let's talk about what happened with a change to this particular act. This act was signed into law. It was in 2010. The United States law was enacted in 2010, right? So what happened later came back in 2018. The Economic Growth, Recovery, Relief, and Consumer Protection Act. This was signed in by the Trump administration, and what this did was this made some changes, right, to the legislation that was in the former act. And what they did was they said, hey, we're gonna raise the threshold from 50 billion. This is very careful. We're going to raise the threshold from 50 billion to 250 billion, for which banks are deemed too big to fail. So any bank that don't have assets more than 250 billion, then those banks are below. They say, hey, they're not deemed to be too big to fail, right? That takes you to these banks here. So let's talk about it. So this rule changed the first rule, right? Changed the Dodd rule. It says, you know what? It was too stringent. We had it to everybody below 50 billion. If you're below 50 billion, you're good. If you're above 50 billion, we're going to be looking at you tight. They came with this law in 2018, 8 years later, and said, let's relax the laws a little bit. Let's just make it 250 billion. Now, I want you to hear from one of the sharks, right? I'm not trying to poke any sharks or any bears, anything like that, but I just want you to hear what he said. And I want you to tell me where this is going to go at the end of this video. And I want you to comment below, but let's hear what he had to say. And I want to see if you agree or not.
I'm not sure Fed policy is to blame for what happened at SVB. I think it's just idiot management. And that's why it's okay to let a bank fail if it's run by idiots. I'm okay with that.
All right. So I'm glad you had an opportunity to listen to one of the sharks here, but let's do some deeper digging. Let's see if you can come up with your own conclusion. So this is page 11 of the financial statements that was released on February 24th. Keep that date in mind. February 24th, just a couple of weeks ago, these financial statements were released. Let's zoom in a little bit more. This is page 11, and let's look at some of the details here. And again, I don't want to make this technical. I just want to make it to a point that it's understandable. When I'm teaching retirement and retirement coaching, I always try to make things as simple as possible. So let's take a look a little deeper inside here. All right, so as we zoom in here, we take a look here. This page 11, and it kind of goes on and it tells you how they're categorized as a bank, right? And so what they're telling you here is, hey, you know what? Under the tailoring rules, banking organizations, they're grouped into 4 categories. So they're basically explaining it to you. It says, based on their U.S., I think it's global size. Let's take a look at this USGSIB. That's basically the list of globally systemically important banks. Again, that's this list that I explained to you. This is the too big to fail banking master list, right? If you're on this list, they're going to be looking at you very stringent, right? And a different set of rules apply for you. But if you're not on this list, if we get around to you, inspect you, we're okay. But there's some things you can probably do before the alarm sounds. But if you're this bank and you show up on the radar a lot faster, you're going to be they're going to get you a lot faster. And what they're saying here is they're saying, hey, you know what? That's category 1. The least stringent of standards apply to category 4 organizations, which have between 100 billion and 250 billion in average total consolidated assets and less than 75 billion in certain risk-based indicators, right? So again, they're still saying, hey, category 4, they're still subject to liquidity risk. They're still subject to these and risk committee requirements, right? But supervisory capital stress testing on a biannual basis. Silicon Valley Bank Financial is considered in category 4 organization. So what they're saying is, hey, out of all 4 categories, we're the least, meaning that by the time they get to us for inspection or anything that we've done, we're at the last line of defense, right? And all of that is playing out in the news because you want to see where the maneuvering and the jockeying came in. So let's take a closer look at their financial statements. And I'm going to tell you, there's something very glaring that if I got these financial statements, I'm a shareholder, I got these financial statements on February 24th. If I got these financial statements, this is what led to the fast run. Let's take a look at it. All right, so I pulled down the financial statements of Silicon Valley Bank. Now, when I look at it, I mean, it immediately jumps out to me, and anybody would understand basic finance, or definitely somebody running a bank, should have known that there was something wrong. That's why you started seeing people or higher ups allegedly start removing their money and taking money out, because this is the red flag. And there was 3 red flags. Let me give you the first one that I see, right? So the first one that I see here is, I'll put it right here. And this is, if we look at both of these in the way they break down, you have your assets, right? Which are pretty much things that you own, right? Or that you can liquidate for cash, right? And even in your own household, you have assets, right? You have a house, you have a car, things that you can turn into cash, right? Things that you own, right? I don't know if car is the best one unless it's a collective car, but that's another story. So, and then you have your total liabilities. So what you have here is you have the first order of business here is you have assets, right? That are valued in assets that says, hey, this is held to maturity securities. And I want to show you that first. And what that basically means is these are securities that they're holding to maturity, means that they may have to hold them for a long time, right? That means they probably can't get out of them, right? And so in a rising interest rate environment, which we have had for the last year and a half or so, these are held to maturity. So what that basically means, if bonds or bond prices are continuing to go up because interest rates are going up, you're already locked in at a low percentage, right? Because they're held to maturity. So that's a dead giveaway when you see here, it says, hey, on our books, it says we have 91 billion, right? But the fair market value is right here, 76 billion. To me, that's alarming, because the fair market value, if we had to liquidate you today, we're already 20 some odd billion in the hole already. Right. And then that's just a break. That's the first red flag. Right. So then let's go to the second red flag. Right. So the second red flag is right here. This is liabilities under the liabilities category. This is interest bearing deposits. Right. Interest bearing deposits. That means the deposits are being put in, we need to pay interest on those deposits. These are interest bearing. It's a substantial leap here in interest bearing from 2001. This was the 2001 end of year to the 2021 to the end of 2022 year. This is a year over year change. This is a substantial difference, major. It's almost, I mean, when you look at the numbers, it's really glaring, right? So when you look at that number, that's probably about, I don't know, 40 to 50. It's almost a 40 some odd % jump just in interest bearing deposits, right? So you look at that. So that means that, hey, they're going to have to pay out interest. They're going to have to pay out interest to the deposit that they have on hand, right? So that's the second thing. Now, let me give you the third, which is the most dramatic to me, is right here. Number 3. Let's move right here. This is what we call short-term borrowings. This is a liability. Short-term meaning anything that's probably going to be due in the next year, right? Or probably due now, right? And it depends on when they got this. But it's short-term borrowings. This is what they have on a book. So short-term always means 12 months or less when it comes to a balance sheet, right? Or it's supposed to mean that, right? Look what they have due, $13.5 billion. Look what they had due in 2021, 71, right? Massive difference. That's almost 19,000%, right? You can do the math. You can do the percentage change from 71 to 13,500. Massive change. Like, again, about 19,000% difference. You can look at the numbers. That, to me, is glaring. And what I'm thinking and what I believe happened is once they saw what was due, and when you look at some of the loans types of loans that they were doing, you would see why that's going to be the case. And I'm going to show that. Let me show that to you in another screen. But again, this means that something was happening. The biggest problem they had is they could not move these assets when they needed to, right? Because these assets were locked. So they couldn't go after higher interest rates. So they were stuck at a certain higher interest rate, but paying a higher interest in interest bearing deposits. Something was going to bust. Something was going to crack at that time. Let's take a look at the next one. So as you can see here, one of the major components and one of the biggest things that kept them out of the light of the big boys is this is 211 billion, right, in total assets, right? 200 billion. The threshold, remember we said the threshold was 250 billion, right? An average total consolidated assets. So if you fell within that window, then you were least likely, and that was a tier 4. That made them the category 4. If they exceed, they tell you here, if we exceed 250 billion on average, then we will be looked at a little bit differently, and there will be more stringent stress testing, right? And so that's the case. They only have 211 billion, right? And again, the bank's been around 40 years. They just kind of got caught in the debt trap of the rising interest rates. This is the same thing that happened to some of the banks that failed back in 2008. This is the exact same thing. They got caught holding a lot of bad debt at the wrong time. It was a perfect storm, and this particular bank got shaken out. Most banks, all banks, do leverage some of the investments that they have or some of the deposits that they have. What happened was there was a run on this bank because word got out with this actual bank. And in a small community like Silicon Valley, word travels fast. It almost went like a spider web, and people just started taking out reserves. So, I mean, they just started taking out deposits. Once you start taking out deposits, you can't meet obligations, right? And so that's how it failed so fast, because a small niche community, venture capitalists, everybody's in that same area in Silicon Valley. That's what failed this bank. Wasn't diverse enough, but I think any type of red flags like these financial statements would have sent a lot of people crazy. And they were making withdrawals and selling shares right after the announcement of the financial statements, which were on February 24th. This is interesting, folks. This is there may be more banks. They're going to go around, do some stress testing. I'm assuming there may be more banks. If you guys want me to do one on a signature bank, theirs is a little bit different, but I can tell you exactly what happened to theirs. I can tell you off the top of my head. I'll do a breakdown for that one. If you want me to, just let me know in the comments and I'll tell you exactly what happened with their bank as well. You guys take care. This has been Jenny Jones, My Retirement Exit. Guys, take care. Goodbye for now.
So are you saying that it's an app that is shown on all of my smart devices? And it is for retirement planning? And it cost less than a cup of coffee?
Yeah, that's exactly it. A retirement planning app in your pocket for less than a cup of coffee.
Interesting indeed.